Hey, welcome back to the channel, Data Financially Follow. In this installment, we're going to be covering Section 121. But before I begin, this is not financial advice. I'm not a financial professional. You always talk to your own financial professional as it relates to the own particulars of your situation. This is purely for educational purposes. So I'm going to be talking about Section 121 of the Internal Revenue Code. Now, what this relates to is the capital gain exclusion that relates to your primary home residence. So currently, if you're single individual, you can exclude $250,000 of capital gain when you sell your primary residence. And if you're married, that $250,000 becomes $500,000, doubles. Great, right? Now the requirements on this is that you have to be in your primary residence 2 out of 5 years, the last 5 years. And there's a lot of different other particulars that kind of go into it, whether or not there was non-qualified use. Like for example, if it started off as a rental property and then it became a primary residence, or as your primary residence that would turn into a rental property, depreciation, recapture. There's a lot of subtle nuances that go on with it. But essentially, if you satisfy the 2 out of 5 years, what you can do is, exclude it, get another place, get the capital gains to build again, exclude it, and rinse and repeat. So with that, it's a really powerful tool to tap into your home equity. And I'm going to kind of go into how you can kind of leverage that into your own personal finances. The only one thing I will say on this is you can't do multiple properties in the same year. So it has to be 1 year. If you're going to go and do this, you also have to be okay with you're going to be moving a lot. In my particular situation, our strategy was we like real estate and we were going to go ahead and buy a property, stay in there, and then sell, cash in on the capital gains, use that money and pay off student loan debt. Now, my wife, she graduated from, her higher educational, had built up quite a bit of student loan debt. And it took us actually a couple different houses to get that all paid off. But instead of it taking, decades to go do so, it only took us 2 houses. Now, we also, because of my veteran status, were able to get into the VA loan. That would give us 0% down. So we'll go into what's a new build community, and getting into an earlier phase allows us to go buy at a lower price. And then as the community starts to build out, it would grow in equity. And then we stay there for 2 years. By the time it gets to the 2-year mark, typically the community is already built out. And now that it's established community, the equity has now built up because now there's all these comps in the community to substantiate a higher one. By doing this, it just required us to go move. And I think the important part about it is not necessarily, yes, we paid off the student loan debt, but it's also what that does to our DTI. That stands for your debt to income ratio. When she graduated, there's a couple $100,000 of student loan debt, and every month was $2,000 a month. It was murder. It was basically another mortgage payment on because of the student loan. But by doing this, after 4 years, we had paid it all off. And instead of $2,000 going out, now we have $2,000 staying in. What does that mean for our cash flow? Our cash flow now is allowing us to go into, let's say, bigger and better properties. We can afford that better mortgage. But I've talked about this before in other videos on how much house is too much house and making sure that we can stay in line. But by you addressing your DTI issue and lowering it, it does ease a lot of the cash flow stress that you have in your scenarios. So thinking about real estate as an asset, but a lot of people get locked up into their real estate and it becomes a very passive asset. It shows up on your net worth statement. But how can you get it to work for you? You can do other things like, a HELOC, that's a home equity line of credit to tap into it, but that's just trading debt for debt, right? Left pocket, right pocket. And technically, that HELOC would give you a 1098 that would show mortgage interest deduction, but that wouldn't be something you could deduct on your actual tax return unless it was used for, substantially improving your home. Now, would the IRS catch on to that? Different story. I'll let you decide if you want to roll the dice on it, but I digress. You're just trading debt for debt. It doesn't actually resolve the debt issue. All you're doing is just trading it. And when you go into that HELOC situation, it will be interest only for, a couple of years before it becomes into interest and principal, but you're just kicking the can down the road. I like this particular strategy because it allows us to, magnify what we're doing. Originally, when we got that student loan debt restructured, it was going to be like a 10-year thing, but being paid off in like 4 years was quite quality of life improvement. And some of our other classmates, they keep on, extending out the loan. It keeps on getting pushed out. Or other clients I kind of deal with too, it's the loan just gets refinanced. It just never gets really addressed. So how Section 121 works. If you can go ahead and just move into that property, let's say you buy a new place, just live in it just 2 years. That's all you got to go do. Once you get to that 2-year mark, you'll qualify for that Section 121 exclusion. Then you would go into, potentially another new build community. This works out really well in California because property appreciation here, pretty much like clockwork. If you were out in the Midwest, I would say you would want to kind of make sure that this strategy would make sense for you. If you can see and track the historical sales in new build communities to see if it can achieve that same kind of goal. But you buy, sell, you buy, you sell. But instead of rolling the equity from house to house, you're just using the equity in the house to pay off your debt. Our case was student loans. Your case might also be student loans. It might be, hey, I have several auto vehicles I'm trying to pay off. I have a business loan, an SBA loan I'm trying to address. I need the funds to go do something with him. It's a nice way to actually get your net worth equity to kind of start working for you. Now, in the very beginning, I kind of talked about some caveats to it. If the house started off as a rental property, and you go move back into it because now it's appreciated. There's been depreciation that's driven down the cost basis, which has increased the capital gain exposure, and you're trying to do Section 121. 2 things. 1, Section 121 does not erase the depreciation. That depreciation recapture is going to happen. Number 2, because you have the period of non-qualified use and the home started off as a rental property before it became your primary residence, there's going to be this pro rata calculation that has to get done to determine what percentage of Section 121 can be used because the home started off as a rental property. However, if the home started off your primary residence, and let's just say, 10 years goes by, it's a rental, you say, hey, I'm going to go right back into it, and then we meet the 2 out of 5 year requirement, you don't have to deal with the pro rata rules on it because it started off as your primary residence first. So tracing the genesis of the home really counts, especially for people who have long-term rentals and they think like, oh, I'm just gonna go jump back into it and I'm gonna do Section 121. I'm gonna get the full $500,000 exclusion. Depending on how long it's been a rental property, you might have to be there a lot longer than 2 out of 5 years to build up, that capital gain exclusion to negate all the years it has spent as a rental property. And then furthermore, if it has all these years as a rental property, you have to think about all the years of depreciation that's been in it that the Section 121 isn't going to magically erase. So I would say if you're thinking about executing this kind of strategy, 1, always talk to your tax advisor. Let them know. Does this make sense? What are potential drawbacks to me doing this? Do I have any, tax implications that I haven't considered? Just like I just outlined right there. And then I would take it one step further. Financial planning should always be the tip of the spear in which we, attack things from. And this is very much financial planning because I'm doing long-term strategy, right? So talking to your financial professional, get that financial plan, see if this makes sense for long-term. And then, if you have any questions, feel free, you can reach out to the channel. I'm more than happy to help. And thank you for tuning in. Thank you and have a great day.